Good day, fellow investors. The quarterly JPM Guide to the Markets is out, and I'm sure you will enjoy all the content that they meticulously put together and show through great charts that we'll go through in this video. We'll discuss whether the market is cheap, when it will bottom, and whether it will bottom, the economy, the fundamentals of the economy and how those impact what's going on, of course, the Fed, and investing ahead, what it is all about. If you enjoyed these quarterly overviews and also a value investing perspective on what's going on in the world, please smash that like button and consider subscribing if you haven't. So let's start by discussing the market. Always great chart showing how the market goes up. This is really the bubble created from the Fed that's now steaming off a little bit, but we have to see how much steam will the Fed let out in this situation. Now, many look at whether it is cheap or not, but for that we have to look at the fundamentals. And yes, currently from the forward earnings perspective, next year or this year's earnings, we are at 16, which is in line, let's say, with the historical averages, even a little bit lower. However, if we look at the previous peaks, it was even lower and then it crashed 50%, which was the case in 2007, only saved by the Fed and money printing. So that is the situation now. Of course, it was more expensive through the dot-com bubble when it crashed again. So we have to see how will this evolve, and most of it from a market perspective, we will see later, depends on the Fed and on how far will the Fed push interest rates, because the economic fundamentals are not that strong. Also, something very important here, the market crashed 50%, but forward price earnings ratios changed also from 15 to 10 because also earnings will crash. So these earnings are still from the expectations of the market, very exuberant expectations that were made here when everything was growing. Nobody is pricing it any recessions or something, and that's why the forward price earnings ratio is still high, because it's made on exuberant earnings, not adjusted earnings. And if we look at the averages, we are there, so we are even below the 25-year forward earnings average for the S&P 500, which you might say, okay, stocks are a little bit cheaper, but wait for the destruction in earnings that can make stocks really cheap, as it was the case during those bottoms. So if you look at the valuations at the bottoms, then you can say, okay, there is still plenty of room for stocks to fall. But the most important thing is, okay, now that stocks are cheaper, of course, automatically returns, expected returns are higher. And if we look at this expected annualized return 5 year ahead, we are now back to the normals of 7, 8, 9%, which is normal for a 15 price earnings ratio. But this doesn't include possible recessions where you can have bad returns, or great economic situations where you can even get higher returns. So this is also an option, but this is also an option. Plus, earnings are a little bit too exuberant for my taste. Because if we check what analysts are still expecting there, we can see that consensus analyst estimates are really through the roof. So in just a few years, earnings have exploded, and especially not earnings explosion, yes, here, but that's not that big here. Just they assume that the good times will continue forever, and that's a little bit too much even for analysts. Yes, I know analysts work for investment banks and they need to sell you, they need your money to be invested, and therefore the picture is always rosy, but this is really a little bit too much. And yes, I know earnings are still growing, but with the recession, with all what's going on, with inflation, those earnings could contract and margins could contract. And that is what usually happens when things slow down a little bit. So there are always estimates that everything will continue to grow forever, but then those estimates often hit reality, and then it is when it gets ugly. If earnings contract on recessions, higher interest rates, higher debt costs, the impossibility to raise more debt, because this has been a debt bubble, also Fed bubble, money printing bubble, whatever you want to call it. But if new businesses cannot raise debt, that also factors in on earnings. So there is plenty of things that might go wrong for earnings. And the Fed said it will curb inflation, so that's something we'll discuss later. And if we look at those declines, this year we are already here at a 24% decline. We had a 34% decline just in 2020. So this is normal for investors. We are just having fun, ups and downs. Of course, these declines make things more cheaper, which is always better for us, but you can always see big declines in a row, which lead to really big declines for the year, crashes 49% down, which is again something that we have to accept. And of course, on the long term, returns will depend on fundamentals, but also keep in mind these are businesses, growing businesses, and despite the average intra-year drops of 13%, every year on average the stock market will drop 13%. Annual returns were positive in 32 or 42 years. That is investing, but then again, also keep in mind this chart starts in the 80s. Why do investment banks show us charts starting from the 80s? Because they don't want to show us charts starting in the 1960s, because from 1965 till 1981 the market went absolutely nowhere. So that is what, about 17 years that the market did nothing, with huge ups and downs. And these ups and downs are also something that we have to discuss. Of course, this is not from JPM, but we can see that things might look terrible, recession, then things might rebound, then again terrible, then rebound. So that is always very, very unpredictable. And yes, over time, stocks usually always go up, but this time it might be different. And especially when it comes to returns over the long term, you can always go back to history and look at those bear markets. This is very interesting. On average, bear markets dure 20 months. So we are 6 months in, still 3/4 of that to go. But then again, you never know. Some have longer durations, 61 months. I hope we are not in a 1930s bear market, even if it is really possible. But the most likely is 40 months down, 20 months down, then 20, 30 months up, then higher, then down, and then again over the long term, coming back to that real zero long-term returns, especially in real rates. Maybe inflation will push stock higher, which will depend on what the Fed does. However, we have to always expect ups and downs, and there are always big downturns, smaller downturns, bigger downturns, and we'll see when will this downturn end. On average, it is 41%, still some room to go. And this is a very nice chart from consumer confidence and the stock market. So when the stock market is down, also the consumer confidence is down, but those are usually much better times to invest than when everything looks great. So you can see how the returns on pessimism are 24%, unlike the returns on positive is 4%. So again, always keep in mind, bear markets, yeah, panic, la 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 li lu la, but bear markets are better times to buy stocks. Of course, in the short term, you never know what returns you will expect. So it can be 40% down still from now a year ago, 50% up. Can also happen with stocks, the green column. However, as you go further into the future, 5 years, 10 years, you can see that, okay, it is possible that you get 1% real return negative now, but it is also possible 20 years. And then with fundamentals, with dividends, with everything, it all smoothens out usually from 6 to 17 over 20 years. So I think that the S&P 500 will likely deliver 6-7%. If we count a little bit of inflation, it will likely be 5, 6, 7% going forward for the next 10, 20 years. Not a bad return, but not even a stellar. 17% is a little bit more unlikely, but this is investing in businesses. And the lower the S&P 500 goes, the better for you. So I can tell you with certainty that this bear market will end. When? That's impossible to know, but it will end, so no worries there. But let's now look at the economic situation to see about the fundamentals impacting market developments. This is a very important chart because it really shows what's going on in the cyclicals sector. After the boom in real estate, it crashed, then nobody wanted to touch real estate for 5-6 years. That's how low things were. Then everything is booming, and now again investment is peaking, but with interest rates going higher, with mortgages being costly, this will usually go down as it is a lagging indicator. Vehicle sales, beautiful chart, are already pretty much subdued as businesses are likely pushing back on investments, which then leads into recession on higher rates. And that is also something that the Fed is watching, but we still have inflation even on lower vehicle sales, which are already below the averages. So business investment is still high, not yet pushed down by higher rates, but will likely come down. And the inventory ratio is still there, still okay, but slowly going higher. And this is also very, very peculiar and shows how it's difficult always to invest, and you have to always look at the hidden risk when you are investing. If we look at the vacancy for real estate by property type, we can see that it is very high for offices. That's why also office REITs are more risky. You expect a higher dividend yield there. Retail now has gone from the lowest vacancy and now to the higher, almost office vacancies. Industrial, as we have logistics issues, have almost no vacancies as things are turning more online, and residential is pretty stable. So also keep in mind that when it comes, but these vacancies for offices signal that there might be something going on with the industry and also retail. Labor demand is still very, very strong, which gives the power to the Fed to do more on pushing those rates because their job is price stability and full employment. Full employment is certainly there. Wages are also growing 6.5%. Keep in mind, wages always usually grow a little bit slower than inflation, so you always lose something there because with 6.5% growth and 8% inflation, 10-12% real inflation, you still lose 4% of your purchasing power. So just something to note here. But unemployment is still very, very low, below the 6% averages, so really natural unemployment, and the Fed can therefore push rates higher and markets lower if they want by focusing just on unemployment. Of course, higher interest rates are there to curb inflation that has not yet started to decline, and then especially if we look at energy and food, we are at 34% and 10%. That is significant. Plus, if you go back to how inflation was measured just in the 90s, we are a few percentage points higher than what they measure now with their qualitative adjustments, etc. For the government, it's better to have higher inflation but lower reported inflation, so they can do better on repaying, refinancing, having lower rates, which is better for the economy. But higher rates will push always the economy into a slowdown, especially with inflation at 5%. We have never had an inflation retreat from 5% without a recession because it impacts everybody. We have seen energy prices higher, food prices higher, which means consumption should go lower, and consumption makes 68.4% of the GDP. So if the Fed keeps pushing and you spend your money, you cannot borrow to buy more things, then it is normal that there will be a recession. Of course, recessions are also normal, but everyone is panicking about it because you never know what kind of recession we will have. However, it is depending on the Fed. Let's see what the Fed has in plan. Because the Fed has created the current situation, has created the asset bubbles into everything. By keeping interest rates at zero for a decade, they tried something here, but lowered them already before the pandemic, and this is now very interesting. The Fed projects to push rates to almost 4%, but the market doesn't agree. The market already thinks that the Fed will have to chicken out sooner and keep interest rates much, much lower. So market expectations are a little bit lower than what the Fed is really planning to do. However, interest rates are still ridiculously low, lower than those should be to curb inflation. Interest rates should be above inflation to curb it. That's at 10%. But look at what would the destruction be if they push it at 10%. Plus, they said that they will start lowering that balance sheet. And if you look at the chart here, that hasn't yet happened. It is flat a little bit, but not going down. And with the current market conditions, we really have to see whether this will go down as planned or not. And something very, very important here, a beautiful chart on real returns on the 10-year treasury. And you can see here how even now the real returns are negative 3%. So if you give money to the US government for 10 years, your purchasing power will be 30-40% lower 10 years down the road, because despite the 3% yield, you are still losing on inflation. Of course, people expect inflation to subdue and therefore have a good nominal and also real return, but that might not be the case, because for inflation to subdue, interest rates have to be pushed back into real territory, and to do that, interest rates have to be at 7% to give back real returns for money. If not, if you're losing money, if you're losing purchasing power, you want to spend it ASAP, which keeps inflation alive. And you can see that only Volcker, when he pushed rates to 20% and above the rate of inflation, stopped the crazy inflation that had been going on for a decade in the 70s. So that's also something to keep in mind. But of course, pushing rates higher hurts. And first, it hurts financial markets that most of us have seen lately, and then it starts hurting the economy. And on financial markets, these ups and downs really show how the Fed will react, what will they do with interest rates. If they chicken out and say, okay, we will cut a little bit on the raises to help the economy, stocks will shoot up, then they will have to intervene again. So it can be really a roller coaster of rates and inflation. And here you can see average interest rates on US mortgages, also in Europe interest rates are going higher. But if you go from 3 to 5.5, if you want to buy a house, it is twice as expensive if you take a loan at the same price almost over 30 years. Despite that, home prices are still going higher, but that might cool off as people are priced out with mortgages. For now, mortgages issue is everyone ran to buy a home here with lower interest rates, and that's also what we said here on the channel, to go short currency by taking a loan. So you were smart if you did it, but now it is still a little bit below the averages, but much more expensive to take a loan. And if it is much more expensive, that can also curb spending with real estate, etc. For now, we don't see it. In 2021, the Dutch market, real estate market, went up 15%. So things are still good and might still remain good, because it is tricky for the Fed to increase interest rates. Because if you look at the wealth, at your wealth, 26% of your wealth is in homes. If interest rates are higher, real estate prices might go lower, and there goes your wealth. Also, financial assets, 41% of the wealth of the consumer is in financial assets. If stock go down, there goes the wealth, there goes the spending, and that can then reflect also into savings and spending and the general economy. therefore the economy can be hit really hard. So the Fed is playing with fire there. And if we look at the yield curve, it's not yet inverted, but it might invert soon because the market will start thinking, okay, the Fed cannot push rates higher, so let me lock in these long-term rates so that I am making a lot of money when the Fed reverts its rhetoric and starts lowering rates. Because when there is a 1% decline in rates, the 30-year treasury goes up 24%. So that's why the curves invert, as people want to lock in long-term gains and also bet on gaining there as those prices move over time. And we have already mentioned how the market is pricing in lower rates than what the Fed is pricing in the current rhetoric. And yes, increasing interest rates hurts, but what if the Fed is out of ammo? Inflation is higher, and if the Fed has to retreat not to hurt the economy, inflation might stay higher for longer. And yes, everyone is forecasting lower balance sheets, lower everything, but they are still all around the world stimulating. Negative real rates are stimulative, so everyone is stimulating because they know that if they revert that stimulus, then a lot of trouble ahead. Look at this. This is the debt pile. So we had the big financial crisis here in 2008 because of debt. Now, fast forward 15 years, debt levels in the world are double. So debt levels are double what they were, and that was a debt issue. So that's financial engineering to the max. They don't know what they are doing, but this is necessary to keep life as is. God forbid hurt someone, God forbid tell people that you have to work and not just borrow to keep things as is. So productivity isn't impacted, but economic growth, yes, for the short term until you have to service, repay, or pay higher interest rates on that debt. And if you look just at the changes in the yield here, that's really remarkable. So double interest rates, double debt costs for most situations here, which is huge. And if this goes to 7%, that is 7, 8, 10 trillions just in interest. And what's very, very interesting is what Ray Dalio says. Okay, you think you can manage this debt, you can this, you can that, but this debt, one's liability, is someone else's asset. And therefore, they are counting on this spending purchasing power. If you inflation it away, then you destroy the purchasing power of the asset of the other people. So you cannot really do financial engineering here over the long term, and that's the issue. And therefore, I see this as a beautiful chart and also an indication of what's going on. Of course, higher interest rates, everyone is rushing towards the dollar. The dollar is getting stronger and stronger. So that might also do good. It's good for America. They can keep buying, and despite all the reshoring and everything, you are buying more globally than before. There is always rhetoric and there is reality. The truth is that this financial engineering environment is an experiment that nobody knows the outcome of. We will see if we survive. I hope we will. Now, when it comes to investing ahead, I think it's better to be positive than negative. We are ingenious people, so we'll find a way to make things work and hopefully end up better. But as investors, no matter the environment, we just accumulate wealth over time, accumulate value, and things end up usually well. And we can see here how, of course, growth margins, growth valuations have crashed, making things cheaper. We'll discuss tomorrow 5 growth stocks to see if there is value there. Yes, growth is an essential part of value, so why not look when things are down in the dumpster? Many growth stocks 75% down, and value stocks are keeping things a little bit more stable, not such destruction there. I've started also discussing dividend yield, so I'll look at the next 100 and then select 5 or 10 interesting dividend stocks to look at. So subscribe, tune in also next week for that. And then also, if you look at where to invest, you can always look at the global map of investments and see that the United States are 61% of the global stock market, while the economy makes just 20% of the global economy. And this really looks like the Fed bubble. Will it burst or not? I don't know. But if you want diversification, if you want to manage your risks, you might want to look internationally. And especially now that the dollar is very strong, everything internationally might be much, much cheaper. Of course, there is risk. It's not your currency. You never know what can happen. However, yields are higher. So at some point, this will again revert as things will be much, much interested abroad. And then you have to see, of course, your portfolio exposure, your everything. It's all personal. But yes, valuations in emerging markets, Europe, are much, much cheaper and lower, so it might offer opportunities. And then also long term, if you look at what's going on in emerging markets, always a beautiful chart from JP Morgan, you can see here how another 1 billion people, 1.5, will enter the middle class, will enter spending, consumption. So these are the long-term trends, and we have seen copper crashing, but demand for that will likely be there. And also, to put things into perspective, we have recently launched our YouTube portfolio. Don't forget to check that video, because we'll be buying globally and then trying to find value globally, but also in the United States. Don't worry. Keep in mind that most businesses in the S&P 500 have 40% of their revenues globally, so even there you can find global investments. That's always something to keep in mind. But then again, also what JPM shows, the secret to investing is not doing stupid things. And you can see here below 20-year returns for the S&P 500 around 10%, and average investors around 3%, 3.5%. Why is that? Because most investors usually do the wrong thing at the wrong moment in time. So don't do the wrong thing at the wrong moment in time. As prices go lower, buy more. Thanks for watching. Check what I do. Check the portfolio we have recently started on YouTube, and I'll see you in the next video.